Hello and welcome to J. Mike Mortgage. And on this episode, Refinances, I'm going to explain a simple, common sense-based approach used by professionals to help you determine whether or not it's worth refinancing your mortgage. Because I want to make sure that you don't regret your refi. I'm going to cover 3 sections. First, 5 different reasons to refinance. The next, don't fall for the term extension savings trick. And finally, I'm going to make some comments about FHA Streamline refinances and VA interest rate reduction refinances. And finally, if you enjoy this video, then please help my channel by hitting like and subscribe. I can think of at least 5 different reasons why you might consider refinancing your mortgage. The most popular one is known in the trade as a rate term refinance, meaning that you're refinancing to lower the rate or you're refinancing to shorten the term of the loan, typically from a 30-year loan to a 15-year mortgage. However, you also might be doing a cash-out refinance. With a cash-out refinance, the new loan amount is higher than the amount that you currently owe, and you take the difference in cash. Rules vary by state on cash-out refinances. I'm coming to you from Texas, and in Texas, you cannot take cash out if you owe more than 80% of the value of the home. So let's take an example. Let's say your house was worth $100,000 and your current mortgage was $70,000. Then you could take some cash out because you could get a refinance loan, assuming you qualify, at $80,000 and take $10,000 of cash out. A good reason to do that would be to use that money to pay off other debt that you had that was at a higher interest rate. A third reason to refinance would be if you had an existing FHA mortgage and you now had enough equity in the property to qualify for a conventional mortgage that did not have a monthly mortgage insurance premium payment. Unlike conventional, where you can normally drop the mortgage insurance at some point in time during the loan process by proving to the lender that you owe no more than 80% of the current value of the property, FHA is different. If you put less than 10% down when you bought the home, then you're going to have mortgage insurance on that loan for the life of the loan. Even if you put more than 10% down, you're going to have mortgage insurance for the first 11 years. A fourth reason to refinance would be to get rid of your escrow account. Now, this is obviously a personal preference. Some people prefer to pay the taxes and insurance with an escrow account, but other people hate escrow accounts. A fifth reason to refinance would be if you had an existing adjustable rate mortgage and you wanted to convert that to a new fixed rate mortgage. My one comment is before you do that, be sure to check with your existing mortgage company to see if your adjustable rate loan has what is known as a conversion option, which may allow you to convert to a fixed rate. You need to see what those terms are and then compare that to refinancing. Don't fall for the term extension savings trick. Here's how to determine when to refinance. Let's take an example. Right now, you've got a mortgage with a $300,000 balance. Your current interest rate is 7%. You have a 30-year mortgage, but you're 5 years into it, and your current principal and interest payment is $1,996 a month. You get this offer for a proposed refinance. A new 30-year loan with a rate of 6%. Yes, there are $6,000 of closing costs, but there won't be any out-of-pocket expenses because we'll just finance them into the new loan amount. You'll end up with a principal and interest payment of $1,835 a month. And isn't that great? Because it's $161 lower than what you're paying right now. Now, would I do this deal? Absolutely not. And I'll tell you why. Because almost all of the savings here in the payment is actually coming from the fact that they're adding 5 years to the term of your loan and calculating the payment based on a 30-year mortgage. If you actually made those additional 5 years of payments, it'd be a lot of money, and you would actually end up paying more interest on the loan than you're going to pay right now, even though the rate is lower. And of course, your balance also just went up by $6,000. What you've got to do to evaluate two offers like this, when you have different terms, you've got 25 years right now, you have 30 years on the new mortgage, is to match the terms. Because you can always pay additional principal every month and pay your loan off early. So you've got to calculate what is the payment on the new proposed refinance as if I paid it off in 25 years, so I can match the terms that I have right now. If you do that, you'll find that the payment based on a 25-year term is actually $1,972. Your payment right now is only $1,996. So in reality, if you match the terms, you're only saving $24 a month, and it's costing you $6,000 to do it. That means it's going to take you 20.83 years to get your money back. I wouldn't do this deal. Two comments about the no out-of-pocket closing costs. First of all, the lender is going to collect a deposit from you up front to pay for the appraisal and the credit report. And if they spend that money and you decide not to close on the refinance, it will not be refunded to you. And secondly, if your new loan has an escrow account to pay for the taxes and insurance, you're going to be asked to make a deposit to start the new escrow account at closing and then wait for your existing lender to refund the balance in your current escrow account. So don't think that you're going to show up at closing with nothing if you've got an escrow account on the new mortgage. Now, in my opinion, going from 7% to 6% on this $300,000 example was not worth doing. However, if you could go from 7% on the existing loan with 25 years left to a new loan at 5%, same scenario. You add the $6,000 of closing costs to the balance, and you figure out what it's going to take to pay the new loan off in 25 years so the term matches the number of years you have left on your current loan. If you do that, you'll get a payment of $1,789 a month. And compared to your current payment of $1,996, you'd be saving $207 a month. And if it cost you $6,000 to do that, you'll get your money back in about 29 months or about 2.4 years. And in my opinion, that is worth doing. When you're trying to make a decision on how much the interest rate compared to your current loan has to drop to justify the cost of refinancing, the loan amount becomes very important. And the reason is that some of the closing costs are fixed. They're the same regardless of the loan amount. But then there are others that do vary according to the loan amount. But the net effect is, as a percentage of the loan amount, the closing costs on small loans tend to be much higher, which means the rate has to drop more to justify refinancing. Let's look at an example. Let's say you've got a $500,000 loan amount, and we'll assume that your current rate is 7%, and your current payment is $3,327, and let's assume once again that you're 5 years into a 30-year mortgage. Now the rate's going to drop to 5.5%. Let's assume that the closing costs are $8,000, which is about 1.6% of the $500,000. So you got a new loan balance of $508,000. You're going to get a new payment, once again, matching the 25-year terms, assuming you're going to pay the new 30-year mortgage off in 25 years, of $3,120. You'd save $208 a month compared to your current payment, and that would pay for the $8,000 in 3.2 years. And that's something that may well be worth doing. But if you take the same example on a $100,000 loan, again, have a current rate of 7%, payment of $665, you're 5 years into the 30-year term, and you're just going down 1.5% from 7% to 5.5%. And we'll assume the closing costs on this small $100,000 loan are $3,000. Now, yes, that's less than the $8,000 of the $500,000 loan, but as a percentage of the loan, they're much higher because the $8,000 was only 1.6% of the $500,000, but $3,000 is 3% of the $100,000. If we match up the terms, you really only save $32 a month, and it'll take you about 7.8 years to get your money back in this example. And I would say that's probably not worth doing. One final thing. Always consider reducing the term of your mortgage. If interest rates have dropped enough to where the payment on a 15-year mortgage is similar to the payment that you're currently making on your 30-year mortgage, refinancing to a 15-year is almost always worth doing. And finally, I'd like to say a thing or two about FHA Streamline refinances and VA interest rate reduction refinances. FHA Streamline refinances are available from someone who wants to refinance going from one FHA loan to another FHA loan. You have to have made at least 6 payments on the mortgage to qualify for a Streamline. It has to be current, and there can be no more than 1 late mortgage payment in the last 12 months. It is possible to refinance on a Streamline from a 30-year term to a new 15-year term, assuming that the new payment is not more than $50 a month above what you're paying now. There's no appraisal required. That could easily save you about $700. And also on a Streamline, there's no income verification. They're going to check the payment history on the mortgage, but that's normally it. This is a good program if you don't have anywhere near the 20% equity that you would need to go conventional and drop the mortgage insurance. There's a similar program to an FHA Streamline refinance available for VA Veterans Administration mortgages. It's called a VA interest rate reduction refinance. It's only available from going from one VA loan to a new refinanced VA loan. The borrower can't be late more than once in the last 12 months on the existing mortgage. It's possible to refinance a 30-year VA loan with a new 15-year VA loan. There's no appraisal required on this program, which should save you around $700 in closing costs. Normally, there's no income verification required, and all of the other documents are minimal. It's not a bad program if it's okay for you to go from one VA loan to another one. Thank you very much for watching this video all the way to the end. If this information has been valuable to you, please consider liking and subscribing. Thank you very much.